Hi, it's Lyman Jackson of Financial Planning Solutions with a quick update on the 3 things you should do now to avoid a surprise tax bill. Every year at this time, I get an email or call about a surprise tax bill. That person is usually completely surprised that they have to come up with a lot of cash to pay the IRS. Often, that's because of a combination of unusual or one-time items. So I wanted to give you 3 things you could do now to make sure to avoid or at least minimize a surprise tax bill. Number one, figure out what changed in 2020. Most tax preparers and tax software provide a 2-year comparison page at the beginning of your tax return. Go dig it out. Think about each item. Did something change between this year and the prior year? Did you cash in shares of appreciated stock? Did you change jobs, receive a severance and a signing bonus in the same year? Maybe you got married, divorced, or did you have children? All of these items can affect the amount of tax due. Once you've determined the difference, estimate how much it will increase or decrease your taxable income. Then multiply that number by your marginal income tax rate. This is usually listed at the end of the 2-year tax comparison. For example, if your taxable income from your last tax return was $180,000, and you estimate that your income went up by, say, $10,000, your tax bill may increase by about $2,400. That's 10,000 times a 24% marginal tax bracket. While there isn't much you can do about this higher income now, especially with the tax year over, you can still set aside the cash that you'll need to pay that higher tax bill when you file your tax returns. Number two, fund an IRA. Once the tax year is over, your options are limited. However, anyone with earned income can still fund an IRA, even though the tax year is over. For 2020, the contribution limit is up to $6,000, or if you turned age 50 anytime in 2020, you can put in a total of $7,000. There are limits on deductibility, especially if you or your spouse is eligible to participate in a retirement plan at work. Note that I said eligible. Even if you don't contribute, that can limit your ability to take a deduction for an IRA contribution. There's another option too, if you were self-employed last year. That's a SEP IRA. A SEP is easy to set up, it has higher income limits, and it can be opened and funded up until the point at which you file your tax return. For 2020, contributions are limited to the lesser of 25% of the employee's compensation, or $57,000. If you want to fund both an IRA and a SEP IRA, you can, but again, deductibility of the IRA may be limited because you also have a retirement plan at work, in this case, a SEP. Number three, update your payroll withholding now. For workers, this is the perfect time of year to adjust your payroll tax withholding. The new calendar year has barely started, and you can affect the amount of tax withholding for nearly the full tax year. To make the adjustment, complete IRS Form W-4. You can find this fillable form on the IRS website at irs.gov. Not sure how to figure this out? Use the worksheets attached to that form. If you work in Massachusetts, you may also want to fill out the state form M4. You can find that form at mass.gov. If you are self-employed and do not receive a paycheck, this is also a good time of year to evaluate and adjust your quarterly estimated tax payments. These tax tips should help you get the new year off to a great start. As always, please consult a tax professional for specific advice concerning your particular tax situation. Have more questions? Give us a call. We're here to help. My name is Lyman Jackson of Financial Planning Solutions. You can reach me at lyman@planwithfps.com. Have a great day.